For more than 4 decades, I've analyzed global markets through some of the most turbulent chapters in modern financial history. I watched capital flee during the final years of the Cold War, traded through the oil shocks that reshaped entire economies, navigated the chaos of the Asian financial crisis, and stood on trading floors as the 2008 collapse rippled across the world. Experience doesn't grant certainty, but it does sharpen your ability to recognize a pattern the moment it begins to form. And today, a pattern is emerging that most people are completely missing. Right now, everyone is fixated on the escalating military tension dominating the headlines, but that isn't the real danger. Beneath the surface, a far more consequential financial event has just been set in motion, an event that, in my assessment, could prove more systemically disruptive than anything we've seen since the 1970s. What Putin and Xi have initiated is not simply geopolitical maneuvering. It is the activation of a coordinated economic strategy with the potential to destabilize the global financial order. And almost no one is paying attention. What almost no one noticed amid the noise of military escalations is the quiet activation of a financial mechanism far more dangerous than any visible conflict. In my view, the real trigger was not a missile, a border maneuver, or a televised speech. It was a coordinated monetary shift by Moscow and Beijing that struck at the core architecture of global finance. Russia has begun demanding settlement for key commodities in yuan rather than dollars. At the same time, China has accelerated the rollout of its digital yuan for cross-border transactions, making it easier for aligned nations to move value without touching the Western banking system. Layered on top of this is the expanding BRICS clearing network, a framework designed explicitly to bypass SWIFT and reduce exposure to U.S. sanctions. Individually, these changes could be dismissed as routine policy experiments. But when initiated together, and at this moment, they form a pattern, a deliberate move to weaken dollar dominance by linking energy flows to a rival currency ecosystem. Western media cameras remained fixed on troop movements, missing the financial weaponization happening off-screen, yet markets felt it instantly. The moment even a single major energy contract shifted into yuan, liquidity models recalculated, risk desks reevaluated exposure, and capital began repositioning. The trigger was small, subtle, almost invisible, but its shockwaves were anything but. When global buyers step back from U.S. dollars and treasuries, the impact is immediate and mechanical. The U.S. government finances itself by issuing IOUs treasuries, and for decades, the world happily bought them because the dollar was the undisputed center of global trade. But when demand weakens, yields don't simply rise, they lurch upward. It's the financial equivalent of a sudden drop in buyers at an auction. Prices fall, interest costs spike. And that's exactly what this de-dollarization shift begins to trigger. Higher treasury yields ripple through the entire economy. Mortgage rates rise. Corporate borrowing becomes more expensive. State and local governments face higher refinancing costs. Even the federal government, already burdened by historically high debt, sees its interest expenses balloon. Money that should go to public services or investment is redirected just to service old obligations. The vulnerability today is far greater than in previous decades. In the 1980s, debt levels were manageable. In the 2000s, globalization was still reinforcing demand for dollars. Now, the U.S. is carrying unprecedented leverage at the very moment key buyers are quietly walking away. Early indicators are already flashing. Sudden outflows from bond funds, unusual volatility in the dollar index, and rapid repricing across energy and metals as traders adjust to new settlement risks. These aren't theoretical warnings, they're real-time signals. The chain reaction has begun, and once it starts, it's difficult to reverse. Wall Street isn't reacting to headlines, it's reacting to the data beneath them. The moment Russia and China signaled a coordinated shift in currency and settlement strategy, markets behaved exactly as they do when confronted with an unfamiliar risk. They moved fast. Bank stocks were among the first to wobble, not because of immediate losses, but because banks are the transmission lines of the global financial system, and any threat to dollar liquidity hits their valuations instantly. At the same time, emerging market currencies swung violently as traders repriced exposure to countries that might follow Russia and China's lead. Gold, the oldest refuge in times of monetary uncertainty, spiked within hours. Safe haven flows didn't just move, they rotated, shifting toward assets historically used during systemic stress. What amplified the panic wasn't human emotion alone, it was the algorithms. Modern trading systems are programmed to detect correlations between geopolitical signals and financial instability. Once those indicators lined up, currency volatility, treasury sell-offs, commodity repricing, automated selling accelerated the trend. In effect, Putin and Xi created a stress test the US never prepared for, and markets, unlike politicians, don't wait for confirmation or debate. They price in fear immediately. There's a far more dangerous vulnerability lurking beneath the market volatility, one that most analysts avoid because it exposes just how dependent the US has become on forces outside its control. For decades, America relied on a steady inflow of foreign capital, stable supply chains, and abundant access to critical commodities. That structure worked until it became a pressure point. In my assessment, Russia and China understand this better than most. They don't need to crash the dollar directly to destabilize the system. They can simply limit what the US needs most. Russia controls vast energy and agricultural exports. China dominates the refining of essential minerals like lithium, rare earths, and magnesium, materials without which advanced manufacturing simply stops. If either nation restricts flows or reroutes supply toward their own financial networks, US producers face immediate bottlenecks. Prices rise, production slows, inflation resurfaces in places policymakers can't easily reach. Yet Wall Street conversations still obsess over interest rates, as if this were a routine monetary cycle. The real threat is strategic resource leverage, the ability of adversarial nations to choke the inputs that keep the modern economy functioning. And the unsettling part is this: these disruptions don't strike all at once. They build quietly, invisibly, until one day the shockwave arrives. It could be weeks, it could be months, but once it hits, reaction comes too late. If the dollar begins to lose its central position in global trade, even gradually, the effects would ripple through American life far more directly than most people realize. A world where BRICS nations routinely bypass the dollar is a world where the US has less control over pricing, less influence over capital flows, and far less insulation from global shocks. When fewer countries need dollars, the currency weakens, and when the dollar weakens, imports become more expensive, not because of tariffs, not because of supply shortages, but because every unit of currency buys less. Imagine paying 20–30% more for electronics, vehicles, medicine, or household goods, simply because global markets no longer treat the dollar as the default settlement tool. History offers uncomfortable parallels. In the 1970s, dollar instability helped unleash years of inflation that eroded purchasing power across the board. After World War II, Britain experienced a long, grinding decline in its currency as its global influence faded. Living standards slipped gradually, almost quietly, but unmistakably. If capital begins fleeing US bonds and equities for safer or more diversified alternatives abroad, that shift compounds the pressure. Markets don't wait for formal announcements, they respond to confidence. And confidence is the first thing that erodes when a reserve currency shows cracks. Empires rarely fall with dramatic explosions. More often they fade through lost trust, and a wounded dollar is how that fading begins. I've lived through crises before: oil embargoes, currency collapses, sovereign defaults, and the unraveling of entire banking systems. But in all those years, I cannot recall a moment when US financial leadership faced simultaneous pressure from both outside adversaries and internal structural weakness. That convergence is what makes this moment different. And far more dangerous. This isn't a call for panic. Panic blinds, awareness sharpens. If the United States wants to maintain the stability that has underpinned decades of global prosperity, it must act with discipline and clarity. That means restoring fiscal credibility instead of relying on endless borrowing. It means rebuilding alliances that anchor the dollar's legitimacy. It means stabilizing debt trajectories before interest costs spiral into a structural burden. And it means securing the supply chains that feed the nation's technology, energy, and defense systems. Because no currency can lead the world if the economy behind it becomes dependent on hostile suppliers. The window for action is narrowing, not closed but narrowing. Markets are watching, allies are watching, rivals are watching, and at the center of it all is a single, uncomfortable truth: global trust is not permanent. It must be earned, reinforced, and protected, because once trust slips, money follows, and once money moves, power moves with it.